Hi, I'm David Giarchodi, Editor-in-Chief of WealthManagement.com, the digital resource for Rep Magazine and Trust and Estates. I'm here at the Morningstar Annual Conference, and with me today is Don Phillips, who is President of Fund Research for Morningstar. Thanks for sitting down with me. I know you're a busy guy.
It's great to be here, David.
It's a wonderful conference. Big one, I hear. Biggest ever?
It is the biggest ever, and congratulations to you on the new site, the expanded name, the rebranding. It's fantastic.
It's just reflecting reality,
yep.
You know. And in your panel yesterday, I was somewhat surprised to hear you and your fellow Morningstar people say that the way you, according to your research, it would appear that retail financial advisors and retail investors in general are getting better at picking good mutual funds. That is to say, lower fees. How else would you describe good? Risk-adjusted return.
Yeah.
It's just that they do it at the wrong time.
That's right. There's a very simple test for this. If you look at it at any asset category or a fund category, just ask, are the equal weighted results better or worse than the asset weighted results? And look at the asset weighting based on the assets at the beginning of the period. And what we see for every category, over almost every time period we look at, the asset weighted results are better than the equal weighted results. And what that means is that advisors and individuals, but mostly advisors, have put the money into the right funds. Mm-hmm. So they pick funds well. Mm-hmm.
Now, we were also, you guys also broached on your panel the problem with some of the regulatory activity going down in Washington D.C. There's a great unknown. Let's face it, nobody quite. Who knows how it'll turn out? There's a lot of uncertainty. But you thought that the Buffett rule, you used that by name, and perhaps some other tax changes will really hurt the financial advisor and other business people.
Yeah. I do think that the political climate and the tax debate right now is really shading in a very negative way for the financial planning community. If you look at financial advisors who have shifted away from a transaction-based compensation to assets under management, then their income is directly linked to the savings that their clients have. Right. Well, right now, the savers assets are being suppressed because we're keeping interest rates artificially low to help out the people that took on too much debt in the last decade. If we're pushing down the returns that savers get and advisors are getting paid on assets under management, it's the advisors who are picking up the tab for that. And it'll get worse next year when the 3.8% surcharge on investment income and capital gains to pay for the healthcare system goes into effect. In effect, what you would say is that its financial planners are going to be one of the forces that are subsidizing that, because if you tax the investment income, then the assets under management go down, the fees on assets under management go down.
Yeah, so
and then it gets worse with the Buffett rule, where you have this potential surcharge on people that have a lot of income in 1 year that's taxed at a rate lower than ordinary income. Mm-hmm. And the main people who are going to get snared up in this are going to be small business people, of which applies to many financial planners. People that maybe take a below average salary for a number of years, mm-hmm. but then get a one-time payoff when they sell the business. Well, it's that one-time payoff, which would have been a capital gain taxed at a lower rate, that gets caught up in the Buffett rule. Right. Now, we don't know which of these things are going to come to play, but right now, the irony is that financial planners that change their business model to do what they believed would help them better serve advisors are getting hit from almost every angle on the tax side.
I hadn't really thought of that before, and that's exactly right. And also, what makes it particularly acute is, according to a lot of the research I read, there are a lot of financial advisors who are 55 plus.
Yes.
They're approaching retirement. Some are already there.
That's right. We're coming to a big transition of a lot of wealth management practices that'll go from the lead advisor who started that to they're selling it to a roll-up firm, or they're selling it to the other partners in the firm. But it's that kind of big one-time wealth realization event that is the most likely thing to get caught up in this new so-called Buffett rule, if it comes to fruition. Right,
because it's too bad, because otherwise financial advisors are sort of regaining their mojo, and that people realize they need some. I think it was you or somebody, I forget who, said it's best done by professionals.
Absolutely. There's a huge role for advisors, and advisors have worked hard to realign their practices so their interests are better aligned with individuals. It's a supreme irony that good behavior may get penalized in this market, and that will penalize both savers and will penalize small business people. And yet they're so essential to our economy.
Yeah, that's typical. Okay, well, that was great. Thanks for your comments. I do appreciate your taking the time to sit with us here at the wealthmanagement.com booth. David Jarachody with Don Phillips, and we're signing off from Chicago.